Endowments are a cornerstone for nonprofit financial sustainability, providing a permanent funding source that enables organizations to support their mission for generations. Yet, nonprofit endowment fund accounting is daunting, with complex compliance requirements and evolving standards. For nonprofits and their boards, proper endowment management entails more than maintaining spreadsheets. It involves building stakeholder trust and ensuring the organization's long-term future. What is an endowment fund? A nonprofit endowment fund is a pool of assets, such as cash, securities, or property, meant to be invested permanently. Earnings from these investments support a nonprofit's programs, operations, or future initiatives, providing stability in unpredictable times. Endowments are built to last, typically preserving the principal forever. Only part of the investment returns are used each year, which helps safeguard the organization's future and honor the donor's intent. Types of endowment funds include permanent endowments. With a permanent endowment, the donor requires the principal to remain intact, allowing only the generated earnings to be used. These are the most common and align with the perpetual nature of endowments. Another type is term endowments. The principal is held for a set period or until a specified event. Afterward, the organization may access the funds. A third is quasi-endowments, which are essentially board-designated funds. Here, the board may decide to treat unrestricted assets as an endowment, but can also change their designation in the future. Each type has different accounting and reporting implications. Essential accounting standards for nonprofit endowments. The primary accounting standard is FASB ASC 958-205. In this standard, nonprofits are required to report net assets in two categories: with donor restrictions and without donor restrictions. Endowment funds typically fall under restricted net assets, with detailed disclosures about the fund's purpose, changes, spending policies, and investment strategy. Financial statements must show the balance sheet with endowment balances, the statement of activities highlighting changes due to income, spending, gifts, and market fluctuations, and also detailed footnotes on endowment policy, spending policy, and investment approach. An underwater endowment occurs when the fair value of the fund drops below the original gift amount. In the accounting standards, mandates clear financial statement display and specific disclosures about board actions, changes in spending policies, and corrective measures. Transparency here in this area bolsters donor confidence, demonstrating prudent management. Investment income allocation. Nonprofits often pool endowment investments, requiring a fair allocation of earnings. Allocations usually reflect each fund's average value over the period, with careful tracking to prevent errors or inequitable distributions. Accounting mistakes in allocation can jeopardize tax status and trust, so robust processes and controls are essential. Next, legal framework and best practices. Compliance with the Uniform Prudent Management of Institutional Funds Act, which we'll call UPMIFA. UPMIFA governs the investment and spending of nonprofit endowments in most states. It outlines fiduciary duties, promoting prudent stewards of endowment funds. Each board member or committee must consider 7 critical factors when setting spending rates and evaluating investment choices. Number 1, the duration and preservation of the fund. Number 2, organization and fund purposes. Number 3, economic conditions. Number 4, inflation or deflation effects. Number 5, expected total return. Number 6, organization's other resources. And number 7, investment policy. UPMIFA offers flexibility, but also places the onus on organizations to proactively manage endowments, document decisions, and ensure alignment with donor intent. In developing a spending policy, a typical endowment disbursement rate falls between 4 to 5% of average fund value, calculated over 3 or 5 years to smooth market fluctuations. Proper documentation, routine board reviews, and transparent communication are all vital. A solid spending policy preserves both the principal and stakeholder goodwill. Endowment Financial Reporting and IRS Form 990. Nonprofits report endowment activity on IRS Form 990 Schedule D, detailing fund balances, contributions, investment earnings, grants, program distributions, and administrative costs. This rigorous reporting tracks board designations, donor restrictions, and fund types, ensuring transparency for regulators and donors. Beyond compliance, nonprofits should maintain clear donor stewardship reports and periodic updates to the board. This strengthens relationships and demonstrates responsible fund stewardship. So, what are best practices for endowment fund management? Establishing strong governance. Building robust governance around the endowment, such as appointing an investment committee. It all creates accountability. The committee sets policies, reviews performance, and ensures the organization fulfills fiduciary responsibilities. Developing comprehensive policies. Key documents in your policies may be an investment policy statement, which outlines the financial goals, risk, and allocation. Another document could be a gift acceptance policy, which clarifies criteria for accepting restrictions. A third document would be a spending policy, details withdrawal procedures. And a fourth document would be administrative fee policy, which explains fund management costs. Maintaining accurate records are also best practices. Tracking donor agreements, restrictions, and transactions using technology for audit readiness and seamless management. Another best practice is internal controls and risk management. Segregate duties, authorize distributions, and automate reconciliations. Internal controls protect both assets and reputations. Common endowment accounting challenges and solutions. Number 1, tracking multiple funds. Using fund accounting software and clear transaction coding, nonprofits can track and manage diverse donor restrictions and funds within pooled investments. Number 2, allocating investment returns. Applying unitization or average balances ensures fair distribution. Number 3, navigating market volatility. Rolling average spending rates help manage market fluctuations. And number 4, ensuring donor intent compliance. Digital archives and routine cross-references guard against unauthorized uses. If your organization struggles with fund tracking, compliance, or reporting, professional CPA or other support can make a critical difference. Outsourcing endowment accounting provides access to expert systems and guidance without expanding in-house staff. Virtual nonprofit accounting services are especially valuable for small and mid-sized organizations, offering scalable solutions. In conclusion, proper nonprofit endowment fund accounting is the foundation for sustainability and donor trust. ASC 958 and UPMIFA compliance are non-negotiable requirements. Best practices in governance, reporting, and record keeping set high-performing organizations apart. Implementing these strategies today ensures your mission thrives for generations to come.